Imagine waking up, checking your phone, and discovering your crypto portfolio has changed overnight, not because of the markets, but because of a new law passed while you slept. This isn't a hypothetical scenario. It's exactly what's happening right now in the United States. The government has just introduced the most sweeping piece of cryptocurrency legislation to date. And if you're holding any digital assets, you need to understand what it means for you. Whether you're all in on Bitcoin, dabbling in Ethereum, or diversifying across a range of altcoins, these new rules could reshape your entire investment strategy. Are you ready for what's coming?
Welcome to FinWise Now, where we break down complex finance into clear, actionable insights. Today, we're unpacking the U.S. government's brand new crypto bill, the Clarity Act, and examining why it could rattle your crypto holdings, from market leaders like Bitcoin all the way to altcoins such as XRP and ARB. In the next few minutes, we'll walk through the key provisions of this landmark legislation, who's most affected, and what smart investors should be doing right now. Let's dive in. First up, what is the Clarity Act, and why is everyone talking about it? Passed by the House of Representatives on July 17, 2025, the Clarity Act is designed to answer one of the most hotly debated questions in crypto. What exactly is a digital asset? For years, regulators have struggled to decide whether tokens are commodities, like gold or oil, or securities, like stocks and bonds. This lack of clarity has been a legal gray area, stalling innovation and leaving investors in limbo. The Clarity Act changes that. For the first time, Congress is drawing a clear line between so-called digital commodities and digital securities. Here's the big distinction. Digital commodities are coins that are decentralized and run on established blockchains. Think Bitcoin and Ethereum. These will now fall under the oversight of the Commodity Futures Trading Commission, or CFTC. On the other hand, digital securities are tokens that are more centralized, often with a company or team behind them, and frequently offer profit sharing or governance rights. These coins, think XRP, Arbitrum, ARB, Lido DAO, LDO, and Aave, AAVE, are now firmly under the regulatory scope of the Securities and Exchange Commission, or SEC. This isn't just a bureaucratic shuffle. The Clarity Act creates a new legal framework for exchanges, wallets, and DeFi platforms, requiring them to comply with stricter rules based on the classification of the assets they list or store. For the first time, Congress has seriously drawn a line between utility tokens and securities, a move that could reshape the entire digital asset landscape. So, which coins are actually affected? In the wake of the Clarity Act, the crypto market is now divided into three zones: the safe zone, the gray zone, and the high-risk zone. In the safe zone, you'll find Bitcoin and Ethereum. Because these coins are highly decentralized and lack a central governing body, they're now officially classified as digital commodities. They're subject to oversight by the CFTC, but the good news is that their status is unambiguous. That's why, even after the announcement, Bitcoin climbed 0.58% to $118,680, and Ethereum jumped 2.33% to $3,691.23. The market is signaling confidence. A regulatory clarity. In the gray zone are coins like Solana, SOL, Avalanche, AVAX, and Cardano, ADA. These blockchains are decentralized, but perhaps not as robustly as Bitcoin or Ethereum. For example, Solana is down 2.99%, trading at $187.19. And Avalanche slipped 0.62% to $23.99, reflecting market uncertainty about where these tokens will ultimately land under the new framework. If regulators decide they're sufficiently decentralized, they could be treated as commodities. If not, they may be recategorized as securities, triggering a wave of compliance requirements. Now, the high-risk zone. This includes tokens like XRP, Ripple, ARB, Arbitrum, LDO, and AAVE. These are likely to be classified as digital securities due to their governance structures or profit-sharing features. If you're staking, yield farming, or using decentralized finance platforms with these tokens, you may soon see sweeping changes. Exchanges and DeFi platforms could be forced to register with the SEC, file disclosures, or even delist these tokens to avoid legal trouble. Your favorite DeFi tokens may soon require SEC filings. That's a game changer for the industry. So how does all this affect your portfolio? The Clarity Act announcement triggered immediate volatility, especially among altcoins in the gray and high-risk categories. Centralized exchanges are now facing pressure to comply with the new rules. Don't be surprised if you see certain tokens delisted until their regulatory status is resolved. Institutional investors, always wary of legal risks, are already reallocating funds away from tokens that might be classified as securities. This could trigger a short-term sell-off and liquidity crunch in parts of the market. If you're a retail investor, now is the time to rethink your portfolio. Diversification isn't just good advice. It's essential in an environment where regulatory risk is as real as market risk. Consider shifting a portion of your holdings into assets with clear regulatory standing, like Bitcoin and Ethereum. And don't overlook stablecoins. They're under increased scrutiny too, with new regulations on how they're issued and backed. If you're using stablecoins as a safe haven or for yield farming, keep a close eye on updates from Congress and the SEC. So, what should you do right now? First, review your current portfolio. Identify which of your holdings fall into the high-risk or gray zones and assess your exposure. Next, watch for announcements from the SEC and CFTC. These agencies will be issuing guidance and enforcement actions in the coming weeks and months. Avoid high-yield schemes and DeFi platforms that might soon be deemed illegal under the new rules. Stay informed by following updates from credible news sources, not just social media or crypto influencers. And finally, keep some of your funds in cold wallets. With regulatory uncertainty swirling, you want to be sure you can access your assets, even if exchanges or platforms face disruptions. Remember, this isn't about fear, it's about being prepared. The market is going to reward those who adapt quickly to the new environment. Regulatory clarity could bring the maturity that crypto needs to attract mainstream adoption and institutional investment. Or, it could stifle innovation and drive projects offshore. Either way, this is not the time to stay passive. If you found this breakdown helpful, smash that like button, subscribe to FinWise Now for more clear and timely financial insights, and drop your questions in the comments. The Clarity Act is just the beginning. Make sure you stay one step ahead.